Picture this. You finally did the responsible thing. You started saving. Every month you moved a little money aside, $100 here, a couple hundred there. You felt good about it, disciplined, financially grown up. Then one day you open your banking app and notice something strange. You've got $10,000 sitting in your savings account, earning almost nothing. After a full year, that $10,000 made you maybe $40 or $50 in interest. $40 for an entire year of discipline. Meanwhile, everyone around you is talking about investing, index funds, the stock market, compound growth, and a quiet thought creeps in. Wait, am I doing this wrong? Here's the truth. Saving money is good, it's responsible, but saving alone will almost never build real wealth. And the gap between knowing you should invest and actually doing it is where millions of people get stuck, sometimes for years, with money just sitting there losing value. So in this video, I'm going to give you the exact step-by-step path to turn your savings into investments safely, without risking your security, and without the overwhelm that keeps most people frozen. By the end, you'll know exactly what to do in what order, starting today. Let's get into it. The hard truth about saving. Let's start with something that might sound controversial. Saving money by itself will almost never make you wealthy. Now, don't get me wrong. Saving is essential, but it's not the destination, it's the first stage. And the reason comes down to one distinction that changes everything once you understand it. Saving protects your money, investing grows your money. Those are two completely different jobs. Money in a savings account is safe. It doesn't drop on a random Tuesday. You can see it, it doesn't move, and that feels good. But here's the cost of that safety. It barely grows, and over time, inflation quietly eats away at what it can actually buy. Money sitting in savings is slowly losing purchasing power every single year. It feels safe, but it's quietly shrinking. Let me show you the math because it's stark. Say you put $10,000 in a typical savings account earning around 1%. After a year, you have $10,100. After 20 years with that interest compounding, you'd have roughly $12,200. Now take that same $10,000 and invest it in a broad stock market index fund. Historically, the US stock market has averaged about 10% per year over long periods. At that rate, after 20 years, your $10,000 becomes roughly $67,000. Same starting money, same 20 years, $12,000 versus $67,000. That is the difference between protecting your money and growing it. And here's the insight most people miss. The biggest wealth gap in this country isn't between people who save and people who spend. It's between people who save and people who invest. The savers stay safe and stay stuck. The investors build real wealth. Same discipline, completely different outcome. Why people get stuck? It's not the money. So if investing is so clearly better for growing wealth, why do so many people with money and savings never make the jump? It's not a math problem, it's a psychology problem. Saving feels safe, investing feels risky, and when your money sits in a savings account, the number only goes up. It never drops. But investments move, sometimes up, sometimes down, and that fluctuation triggers something deep in our brains. We are wired to avoid loss far more strongly than we're motivated by gain. So watching a balance that could drop, even temporarily, feels threatening in a way that a flat savings balance never does. That fear is completely normal, and the answer isn't to ignore it or pretend you should be fearless. The answer is to build a transition that respects that fear. A path that moves you from saving to investing in stages, not in one terrifying leap. When you do it in the right order, the fear shrinks because at every step your security stays protected. So let's walk through that exact path, step by step. Step 1, build a real emergency fund first. Before you invest a single dollar, you need an emergency fund. This is non-negotiable, and it's the foundation that makes everything else possible. An emergency fund is 3 to 6 months of your living expenses held in cash in a savings account. This money is not for investing, it's not for opportunities, it's for life. A job loss, a medical bill, a car that breaks down, the unexpected things that always eventually come. Here's why this comes first, and it's the part most people don't understand. The single biggest reason people panic and sell their investments at the worst possible time is that they needed the money too soon. They invested cash they couldn't actually afford to leave alone, the market dipped, an expense came up, and they were forced to sell at a loss. An emergency fund prevents that entirely. It protects your investments from your own life. When you have 3 to 6 months of expenses sitting safely in cash, a market dip is just a number on a screen, not a crisis. because you're never forced to touch your investments to cover an emergency. The emergency fund is what lets you stay calm and stay invested through anything. So before anything else, if you don't have 3 to 6 months of expenses saved, that's your first job. Some of the savings you already have may already be serving this purpose, which is great. That money stays right where it is. Step 2, separate your money into 2 buckets. This next step is simple, but it changes everything mentally. You need to divide your money into 2 distinct buckets. Bucket 1 is your safety money. This is your emergency fund and any cash you'll need within the next few years for a planned purchase, a house down payment, anything with a near-term deadline. Safety money stays in savings. It does not move. Its job is to be there when you need it. Bucket 2 is your growth money. This is money you won't need for at least 5 years, ideally longer. Growth money is allowed to fluctuate because its entire job is to grow over time. When this bucket drops temporarily, you don't panic because you've already decided in advance that you won't need it for years. This mental separation is powerful because it removes the anxiety that stops people from investing. The fear of investing usually comes from secretly worrying you'll need that money soon. But once you've clearly walled off your safety money, your growth money is free to do its job and the fluctuations stop feeling threatening. You've given each dollar a job and you've made peace with what each one is allowed to do. So look at your savings right now and ask, how much of this is safety money I might need soon? And how much is growth money I won't touch for years? That second number, that's what's ready to be invested. Step 3, answer the lump sum question. Now, if you've been saving for a while, you might have a chunk of growth money ready to go. Maybe $5,000, $10,000, $20,000. And this raises a question that paralyzes a lot of people. Do I invest it all at once or a little at a time? Here's the honest answer. Historically, investing a lump sum all at once has produced better returns most of the time, simply because the money gets more time in the market and the market trends up over the long run. So mathematically, investing it all at once usually wins. But, and this matters, investing a large amount all at once is emotionally hard. And if the market drops right after you do it, you might panic and abandon the whole plan. So there's a second approach that's often better in practice, even if it's slightly worse on paper. It's called dollar cost averaging. Instead of investing your whole lump sum on day 1, you split it into equal chunks and invest them on a set schedule. Say, over the next 3 to 6 months. This smooths out your entry. If the market dips during that window, you're buying at lower prices. If it rises, you're still participating. Most importantly, it removes the pressure of trying to pick the perfect day, and it makes the transition feel safe enough that you'll actually follow through. For most people, moving a big savings balance into investments for the first time, dollar cost averaging over a few months is the right call. Not because it's mathematically optimal, but because it's the approach you're most likely to stick with. And the best plan is always the one you actually follow. Step 4, start small and automate the habit. Whether or not you have a lump sum, the real engine of this whole thing is consistent, ongoing investing. And the good news is you don't need much to start. A lot of people think investing requires thousands of dollars. It doesn't. Most brokerage platforms now let you start with as little as $50 or $100. The goal at the beginning isn't big profits. The goal is building the habit, because in investing, the habit matters far more than the amount. So here's what you do. Open an investment account. A Roth IRA is ideal for most people because it grows tax-free, or a regular brokerage account works too. It takes about 10 minutes online, then set up an automatic recurring transfer from your checking account into that investment account on the same day every month, right after you get paid. Automation is the secret weapon here. When investing happens automatically, before you ever see the money, it becomes effortless. You're not making a decision every month. You're not relying on willpower or motivation. The money just moves quietly month after month, whether the market is up or down. This is how ordinary people build extraordinary wealth, not through dramatic moves, but through a small automatic habit running in the background for years. Step 5, keep it simple. Buy the whole market. Here's where beginners often sabotage themselves. They finally decide to invest, and then they jump into the complicated stuff. Day trading, options, picking individual hot stocks, chasing whatever's trending. And most of them lose money doing it. The truth is almost funny. The simplest investment usually beats the complicated ones. And that simple investment is a low-cost, broad market index fund. An index fund is a single investment that holds hundreds or thousands of companies at once. When you buy a total stock market index fund or an S&P 500 index fund, you instantly own a tiny piece of all the biggest companies in the economy, in one purchase for almost no fee. You're not betting on one company getting it right. You're betting that the overall economy keeps growing over time, which it has over every long stretch in history. This gives you instant diversification, rock bottom fees, and reliable long-term growth, all in one move. You don't have to research companies. You don't have to follow the news. You don't have to be smart about which sector is hot. You just buy the whole market and let it grow. This isn't a fringe opinion. One of the most successful investors who ever lived has repeatedly said that for most people, a simple low-cost index fund is the best investment they can make. If the greatest investors point regular people toward the simple option, you can trust that you don't need anything more complicated. So your investment, in plain terms, put your growth money into a broad market index fund automatically every month. That's the engine. That's the whole strategy. Step 6, stay calm when it drops. There's one final step, and it's the one that separates people who build wealth from people who don't. You have to stay calm when your investments drop, because they will drop many times. Over your investing life, you'll watch your growth money fall 10, 20, sometimes 30% during market downturns. Every one of those moments will feel like a reason to pull your money out and run back to the safety of savings. And every single time in history, the market has eventually recovered and gone on to new highs. Here's the reframe that changes everything. When the market drops, you're not losing money. You're buying it on sale. Because you're investing automatically every month, a market drop means your same monthly amount is now buying more shares at lower prices. Downturns are when disciplined investors quietly get wealthier because they keep buying while everyone else panics. Think of it like this. Saving money is like storing seeds in a jar. They're safe, but nothing grows. Investing is like planting those seeds in soil. At first, it looks like nothing's happening. Some seasons are rough, but over time, things grow, and eventually you have something far larger than the seeds you started with. The investors who win aren't the ones who react brilliantly to every market move. They're the ones who set up a good system and then refuse to panic. They think in decades, not days. Your job, once your money is invested, is simply to leave it alone and let time do the work. The bottom line, let's pull it all together. Here's the complete path from saving to investing. First, build a real emergency fund, 3 to 6 months of expenses in cash. That's your foundation. Second, separate your money into 2 buckets, safety money that stays put and growth money that's free to grow. Third, decide how to deploy any lump sum. For most people, spread it over a few months so it feels safe enough to follow through. Fourth, start small and automate a monthly investment so the habit runs itself. Fifth, keep the investment simple, a low-cost, broad market index fund. And sixth, stay calm through the drops and let compounding do its work over years. That's it. That's the entire path. And notice, at no point did you have to gamble, get lucky, or risk your security. You moved from saving to investing in stages, with your safety always protected, taking one reasonable step at a time. Here's the truth most people learn eventually, often too late. Saving money gives you stability. Investing gives you freedom. You need both. But if your money is sitting entirely in savings right now, you're only doing half the job, the half that protects you, not the half that builds your future. The good news? You now know exactly how to do the other half, and you can take the first step today. If this video gave you a clear path from saving to investing, do me a favor and subscribe. Net Worth Nation is built for people who are done leaving their money stuck on the sidelines and ready to actually put it to work, safely, and starting from wherever they are. Drop a comment below. Be honest. Are you still in the saving stage, or have you already started investing? And if you're about to take the leap, what's the one thing that's been holding you back? I read every single comment. And if you know someone with money sitting in a savings account who's been meaning to start investing for years, share this video with them. This might be the push that finally gets them off the sidelines. You've already done the hard part by saving. Now let's make that money actually grow. I'll see you in the next one. Let's build.